In this video, we're going to be discussing Fibonacci retracements. You will learn what retracements are, the benefits of trading retracements, and how to use the Fibonacci tool. So to start with, what is a retracement? Retracements are basically short-term price corrections during an overall larger uptrend or downtrend. These are temporary price corrections that don't indicate a change in the direction of the larger trend. So the main benefit of retracements is that you can enter a trade in the direction of the larger trend at a better price just before the continuation of the larger move. So why do retracements occur? Well, as you can see on my screen, this is a large upward trend. And traders are buying because they assume that the market price will continue going up. As more traders notice the movement, they will start to buy too. When the market has gained traction, some traders will close their positions for profit, which will result in a temporary sell-off, and the market will pull back and the upward trend will temporarily suspend. After this, the original forces that formed the trend will resume their activity and the price will continue to go upwards until the trend has run its course and reverses. So how do you open a trade during a retracement? Well, in theory, the first thing you should do is find a strong upward or downward movement. To find a good entry point, look to enter the trend after a retracement or pullback has occurred. Put simply, you should buy pullbacks in an uptrend and sell rallies in a downtrend. But how do we know when the market is going to pull back? This is where Fibonacci retracements come in. The Fibonacci sequence, or golden ratio as it's also come to be known, is 1.618, and it is the mathematical relationship between two objects. It can be found across all of nature, plants, animals, weather structures, star system, and is ever present in the universe. And this ratio is the key to everything from the number of spirals on a sunflower head, our own limbs, the encryption of computer data, and why the Mona Lisa is so pleasing to the eye. It appears to be a kind of built-in numbering system to the cosmos. It is also important in the financial market, and many traders use the Fibonacci sequence to calculate retracement levels in their trading strategies. So what exactly is the Fibonacci sequence? Each number in the Fibonacci sequence is calculated by adding together the two previous numbers. So as you can see, 1 plus 1 equals 2, 1 plus 2 equals 3, 2 plus 3 equals 5, and so on. What is significant about this pattern, however, is that the ratio of any number to the next one in the sequence tends to be 0.618. So if you divided 34 by 55, then you get 0.618. If you divide it by 55 by 89, which would be the next two numbers in the sequence, you would get 0.618. And if you divided 89 by 144, you would get 0.618. Also, the ratio of any number to the number two places ahead in the sequence is always 0.382. So if you divide 21 by 55, you get 0.382, 34 by 89, 0.382, and so on. And similarly, the ratio of any number to the number three places ahead tends to be 0.236. Dividing these Fibonacci ratios will result in either 0.618 or 0.382, as you can see here. So it stands to reason that the numbers you'll find on the Fibonacci retracement tool are the same numbers. And it is widely accepted by most traders that these trends will usually retrace around the Fibonacci levels and usually around the 50% level. So this means that in an uptrend, a price will retrace a certain percentage of the move before continuing its long upwards movement. And traders will generally use these levels because there are so many other traders that are setting their sell, buy, and take profits at these different levels. And so it almost becomes a self-fulfilling prophecy. So how do you use the Fibonacci retracement tool? Well, as you can see here, drawing Fibonacci retracement levels is a simple three-step process. So during an uptrend, step 1, you would identify the direction of the market. Step 2, you would attach the Fibonacci retracement tool on the bottom and drag it to the right all the way to the top. And step 3, you monitor the three potential support levels as 0.236, the 0.382 level, and the 0.618 level. And as you can see on my screen, the levels tend to pull back accordingly. And the same process works for a downtrend. As with any other trading tool, it's important to confirm your entries and exits by using other technical indicators. You should always combine Fibonacci levels with Japanese candlestick patterns, oscillators, and indicators for a stronger signal. And as you can see on this chart, the pattern is confirmed by the fact that prices are trading above the moving average line and that the MACD or MACD is above the 0 line. So now that you've decided on an entry point, you can decide on where to place a stop loss and where to place a take profit. We suggest that you place your stop loss for the upwards trend just below the retracement level or the support level, and in a downtrend just above the retracement level or the resistance level. And where should you place your take profit? Many traders place their take profit levels at various Fibonacci extension levels. For example, the 26.3% level, the 38.2% level, and the 61.8% level. Because these correspond to retracement levels, it makes it simple to find a take profit level. So to summarize, a retracement is basically a short-term pullback or rally during a longer trend. The benefit of using Fibonacci retracements is that they allow you to enter a trend at a better price. The basic premise of the Fibonacci retracement is to buy during a pullback on an uptrend and to sell during a rally on a downtrend. Thanks for watching. If you have any questions regarding Fibonacci retracements or any other trading tool, please send us a message. Our website is FxScouts.com, and please remember to subscribe and like. Cheers.